Hello everyone, my name is Sarah Simpkins and I'm the Senior Employer Services and Compliance Specialist at Savoy. Today we're going to be following a little case study on certain ERISA provisions. This is the first in a series of case studies as we follow an employer through the small group, mid-size, and large employer market. We're going to discuss not only the big ticket compliance items that an employer needs to know about, but even the little everyday things that an employer would want to know when it comes to how to administer their benefit plans for their employees. If you have any questions after reviewing this video, please direct them to your dedicated Savoy account representative. To begin, I think it's really important to discuss what ERISA is. ERISA stands for the Employee Retirement and Income Security Act, and it was enacted in 1974. This is the foundation that governs all of healthcare law, including Section 125, COBRA, and a whole lot more. So let's begin with Miss Emily Employer. Emily is just starting her business and currently has 3 employees under her, and she wants to know what she needs to do to get compliant and start offering benefits. But hold on. First, we need to know, are the employees allowed to use pre-tax deductions to pay for their benefit premiums? If so, Miss Employer has created a Section 125 plan for her employees, which means she needs a Section 125 plan document. And even though she's a small business, there's no size or employer type exemptions for who needs a Section 125 plan document. Section 125 refers to the section of the IRS code which allows employees to make pre-tax deductions to pay their premiums. Any employer which allows employees to do this must have a written Section 125 plan document. The written Section 125 plan document must specifically describe all benefits and establish rules for eligibility and elections. It also outlines how benefits will be administered. This document just needs to be retained by the employer. There's no requirement to distribute it to employees unless a written request is made, and then Emily has 30 days to provide the document. The Section 125 plan document must be in place on or before the first day of the plan year in order to allow employees to make pre-tax deductions. If Emily chooses to allow employees to do pre-tax salary reductions for premium payments without this document, there could be some serious tax consequences for everyone involved. And Emily is the one responsible for creating and maintaining this document. Her payroll provider or carrier will not be doing this for her automatically, as there are some employer-specific provisions that have to be in there that the carrier or payroll provider wouldn't automatically know. Emily can have this document created on her behalf if she reaches out to her broker, who connects her with our Savoy document drafting services or another third-party vendor who provides these services. Now, Miss Emily Employer is thinking about how she can communicate her benefit offerings to her employees. And this brings us to the next ERISA document, the Summary Plan Description, or SPD. This document is automatically distributed to employees, and again, it's not something that their carrier will create for them. It's up to Emily here. It can be distributed via paper or, in some cases, electronically, although often consent is required for electronic document delivery. The document is the main vehicle for communicating to employees plan benefits, rights, and obligations to participants and beneficiaries. It must be written in a way that the average participant could understand, and this is the opposite of its sister document, the plan document, which is written in a very formalized way. Specific information must be included, such as the plan number, and since I field this question a lot, I will offer some guidance here. The plan number for an ERISA plan always starts at 501. The plan numbers then go up from there. When a plan renews, the plan number doesn't automatically change, but rather carries through the years. Once a plan number is assigned, it should always be used in connection with that plan and should not be used for any other plan. For example, if an employer has a medical plan, they may draft an SPD and list this as Plan 501. If the employer later offers a dental plan and does not have a wrap SPD, although we'll hear more on this later, the plan number for the dental plan would be 502. It also must include a plan name, such as your company name, health and welfare benefit plan, not HDHP 5000, for example. It also must include the plan sponsor EIN, a description of plan eligibility provisions, plan benefits, information on plan contributions, including whether a benefit is 100% employer paid, 100% employee paid, or a mixture of both, and a statement of ERISA rights. Recipients of the SPD include plan participants, COBRA qualified beneficiaries, a parent or guardian of a child under a QMSCO, a retiree who remains entitled to benefits, a spouse or other dependent of a deceased employee, and providers can receive this document upon request unless there is an anti-assignment provision. And as for timing, the SPD must be provided within 90 days after a participant first becomes covered under the plan. For new plans, the SPD must be provided within 120 days after the plan first becomes subject to ERISA, or it must be provided within 30 days of a written request by a participant or beneficiary. An SPD rewrite is required every 5 years, or every 10 years for a plan that has no intervening changes. Intervening changes include changing carriers, policy numbers, adding or removing a benefit, and a whole lot more. So as you can imagine, most SPDs are updated well before the 10-year limit. This document must be delivered in a way that is reasonably calculated to ensure actual receipt of the material. Some examples here are first-class mail, hand delivery, and electronic delivery, although there are certain rules around electronic delivery of the SPD. For participants who have work-related computer access, employers can distribute to those who have the ability to access documents at any location where a participant could reasonably be expected to perform employment duties, or whose access to the electronic information system is an integral part of their employment duties. So, for example, if the employees work in an office with regular computer access, electronic delivery is acceptable. For participants who do not have work-related computer access, the employer has a few more rules to follow. First, the employer must obtain the individual's affirmative consent in a manner that is reasonably demonstrated that the individual has the ability to access information in the electronic form that will be used. The individual must provide an address for delivery, and consent must occur after the individual has been provided with a notice that explains the types of documents that will be provided electronically, the consent that can be withdrawn without charge, the procedures for withdrawing consent and updating their information, the right to request a paper version and whether a charge applies, and the electronic delivery system and what hardware and software will be needed to use it. This notice requirement, which is one of many notice requirements that an employer has to adhere to, applies to all electronic recipients and must be followed each time an electronic disclosure is made. Furnishing a general notice on a periodic basis is not considered acceptable. And this document is required for every employer who offers benefits, regardless of size or whether they're self-insured or fully insured. And if Emily wants to offer multiple benefits from various carriers, such as a vision with VSP, a dental with MetLife, and a health with Horizon, she may want to consider a wrap SPD. A wrap SPD and plan document essentially combine benefits from multiple carriers into one document. Therefore, instead of having multiple separate SPDs and plan documents for each benefit, there's only one SPD and plan document for all of the benefits. This is advantageous to Miss Emily employer for a few reasons. First, it allows for ease of distribution. She would only need to distribute one SPD instead of multiple. It is also more administratively simple, including when an employer has to update their documents for changes upon renewal. And finally, there are Form 5500 implications. To keep it simple and not get too off into the weeds, a Form 5500 must be filed for each benefit with 100 or more employees on the first day of the plan year. If an employer has multiple SPDs, or worse, no SPD in place, multiple Form 5500s may need to be filed. If there's a wrap SPD in place, one Form 5500 can be filed for all benefits together. And lastly, since we mentioned it, Emily wants to know, what exactly is the plan document? Every plan subject to ERISA must have a written plan document. The plan document controls the operations and administration of the plan and has to describe terms and conditions, and this is typically seen as definitions of certain language and rules for operating under the plan. Benefits provided should be listed, such as medical, dental, vision, and others, for example. Eligibility provisions, such as whether there is a service requirement. And it must also detail the rights of participants and beneficiaries. The most notable here is HIPAA, but there are a whole host of others that need to be listed as well. There are also several required provisions, like COBRA and USERRA rules, and naming a plan fiduciary, among many other items. Distributing the document is required if a written request is made by participants, beneficiaries, and sometimes providers, but this depends on whether the document contains an anti-assignment provision. If a written request is made, the document must be supplied within 30 days of the request. This document is extremely important for outlining the general terms and provisions of the plan. Often, when an employer has a question regarding their benefits, we ask them to refer to their plan document first. So, what are the penalties for not being compliant with ERISA document rules? Well, first of all, the employer will lose any deferential treatment in court. This means that if there's a challenge to the way the benefit plans are administered, the employee will get preferred treatment since the employer failed to outline the terms of the plan when they had the chance. In addition, there are various monetary penalties for document noncompliance, including fines up to $5,000 or imprisonment for up to 1 year for willful violation of ERISA provisions, fines of up to $100,000 and imprisonment up to 10 years, and fines up to $10,000 or imprisonment up to 5 years for making any deliberate false misstatement or representation of fact. Additionally, an IRS penalty of $110 per day may apply for failure to furnish certain information to participants within 30 days of a request. Also, a Department of Labor penalty of $100 per day, up to a maximum of $1,000, may apply if these documents are requested and not provided within 30 days. So, what should Miss Emily employer do to make sure they're compliant with the ERISA plan document rules? The first is she would reach out to her Savoy compliance to get started. Our turnaround time once we receive all of the required information is 1 to 2 weeks. At renewal, she should make sure the plan documents are updated to reflect the most current plan information. Our next recommendation is for Miss Emily employer to review our compliance calendars to make sure she's keeping up to date on all of her other compliance obligations as an employer. So tune in next time to learn about the calendars and how they can be used as a roadmap for all kinds of compliance needs, not just ERISA documents.